Welcome back, YouTube. So in this video, I wanted to focus more on some of the macro things that will affect most of our portfolios and possibly the foreseeable future as far as for how we invest and what we invest into. So we know that there's growing pressure in the for the rate hikes as far as the runaway inflation, and the inflation is actually worse than I actually thought, and I don't believe that's around 7%, but we're going to get to that. We have the increasing potential for there to be a breakout in war between Russia and Ukraine. I'm not a war analyst, but I know for a fact that will have an effect on the market, at least in the short term, depending on the degree of involvement we have. And I know that ultimately this will determine how aggressive the Feds are going to be with the interest rates, whether or not we're going to have that increase in investing in bonds because of the uncertainty in the market, bonds and things like gold, and ultimately how much money or institutional money will be vacuumed from the market and what the market actually looks like without that institutional money. All coming off of the cusp of the greatest hike as far as for numbers and the of retail investors into the market who have pretty much been started investing at the peak of the liquidity in the market, and pretty much everything that you could buy into was pretty much increasing in value. And now we're going to have more of a return to a more normal market. And the question is, will not only the market be able to adapt, but also the amount of retail investors who have technically, this is their first time in the markets, they have not experienced a normal market or a bear market for that matter. And will they be able to adjust, or will these habits that have been developed over the last couple of years come back to haunt them in a normal market? So let's get into it. So first off, I want to say that I believe that inflation is much worse than 7%. I believe that the government is calculating it something like what they do with unemployment numbers. When after, I believe, like 3 months, you fall off of the counter basically, and the numbers are able to come down a lot faster than what's actually reflected. And we also know that there are also lagging indicators as well. You can look at rent rates and stuff like that, where the people may be actually tied into like their leases, so you may not be able to reflect the actual increase in rents and stuff like that until those leases come up. So a lot of the indicators that are used are not necessarily used, so will not necessarily report the actual inflation rate or the actual purchasing power, the dollars and stuff that we have immediately. But it does not mean that it's not already cycling itself through the market. So when we look at, let's take a look at a lot of the different businesses here. We see that Amazon has increased its Prime account. We see that Netflix has increased. We see things like Chipotle. I'm going to post a bunch of them on the screen now here for you to look at, but we're seeing rate hikes all across the board. And I'm not saying that it's all purely inflation, but because obviously when entrepreneurs, businesses realize that inflation is not transitory, they're going to start passing on those increasing prices via supply chains and just inflation prices just for the cost of goods, the cost of production. They're going to start passing on those prices now, and also some of them are going to increase profits just simply because if people are willing to pay for it, regardless of what happens with inflation, they may not lower the prices after, especially if they have a monopoly in the market, after we get some stability in inflation. But in the meantime, when you say that we see these the CPIs and stuff come out and they'll say, oh, the job market is strong and unemployment is low, then you're going to have the attraction of people like Powell to want to trim some of that and say that, oh, hey, look, we have this room, this grace period here to increase these rate hikes to get inflation under control. He's already expressed to us that the Fed's purpose for existence is not to moon our stocks or to bail out the stock market. Now, we've seen this a couple of times, 2018, 2020, definitely with the pandemic, where they'll come in and they'll start bailing out the market. And we've also seen back in 2018, we've seen the Fed kind of retract their statement just based off of how the market was reacting, because it was pretty much going through the floor. Will we get that this time? I don't believe we have the room for the Fed to retract too much just because of the amount of inflation that we have here now. So because technically speaking, you can retract and technically kick it down the road, but the question is, how far could you kick it before we start seeing double-digit inflation? So the Fed's pretty much going to be in between a rock and a hard place. And we also know that they're having secret meetings and stuff like that. And this is one of the things that kind of spooked me out when we had the initial Fed meeting a few weeks ago. And Jerome Powell pretty much said that they weren't sure of what type of rate hikes, like what percentage and stuff like that, or the amount of rate hikes that, and they will be discussed or determined a little closer to March 16th. So for me, personally, I believe that's a lie, blatant lie. I don't believe that you have a team of people whose literally their job and sole purpose of existence and their role is to monitor inflation and to keep inflation and market participation, i.e., jobs, under control, or at least at a neutral point as far as for inflation and obviously growth in the job sector. For them to say, "Oh yeah, we know these are issues, but nothing's been decided." You don't have an idea of the range here. And for me, I personally believe that that was him not trying to already add panic to the market, because just the week before, we know that the market pretty much went to the floor and had around almost a 10% correction overall, based on the thought that the money would be removed from the market. In this case, if you don't know what money I'm talking about, we've been getting roughly around $120 billion a month injected into bonds, mortgage-backed securities for like the last year, aka massive liquidity going through the market, funny money everywhere. And people have been able to borrow money excessively for margins and really pump up portfolios, pump up crypto. And there's a lot of money in the market that's going to have to leave, or money is going to become a lot tighter, or more difficult to borrow. So a lot of the things that we've seen in 2021, 2020, we're not going to see going forward here if these policies change, because the money is not going to be as fluid. For us and the effect on our portfolio, we need to take into account here that the market overall is changing. We need to have, as far as we're balancing out our portfolios and not just being ignorant, and making sure that we're not just chasing moonshots, whether that you're in crypto or in stocks, especially in crypto more so. In stocks, we'll see, the companies that have value, utility, leadership, vision, stuff like that. Same thing in crypto. These coins are going to be okay. They may have a correction as far as that institutional money come out, but that'll just create buying opportunities for the people who are long in these positions. So personally, I'm looking for a 20% or greater correction, because I like to have a little bit more spread on my entries. But if you're looking to average in, dollar cost average in, just kind of be careful, because when you start averaging in at 2% and 5%, and just because you see a green candle the next day doesn't mean that we're off to the races. The overall catalyst, I don't care what happens in the short term, you're going to have to start overlapping and balancing both. But the overall catalyst for the market has not changed. And you're going to have a long term. Start thinking in terms of 6 months and 12 months as far as for what your portfolio is going to look like. Because if you start averaging in at 2% and 5% and those little small spreads, and you run out of money, you're not able to average in any further, or you're over leveraged in general, you're going to have to sit this cycle out deep into the red. And a lot of people have done that in crypto, who were simply trying to trade it or looking for quick money. And then now they turn into long-term investors because they don't have a choice and they can't make the exit. So give yourself the opportunity to capitalize off of that. I'm not saying don't buy in. I'm not saying coin count doesn't matter. Obviously it does. But if you can spread it out on a weekly investment, or every 2 weeks, every month, or something like that, give yourself the time and the opportunity to capitalize off of the potential of there being lower rates, because the catalysts are out there. The market, these numbers are not lying. Like this cannot continue the way it is. This is just a mathematical fact. The biggest thing going forward is, because I do believe we'll see a few more bounces along the way, and it'll give you the illusion that things are okay, or if people want some refunds and stuff like that start coming back, you may see people take some investments, and we'll have these short-term bounces in the market. But just keep in mind the overall catalyst for the market has not changed. So just keep that in mind. And like I just finished saying, give yourself the opportunity to capitalize off of potentially lower rates until we get some certainty in the market. The market does not like uncertainty. And when you see this type of uncertainty in the market, you'll typically see people start investing in hedges or something with more of a guaranteed return. So that's when you'll see money start flowing into like bonds or gold and things like this here, to try and hedge themselves and pretty much wait for the market to overall bottom out. So that's what I'm saying. Those are just my parameters for buying the dip. I'll try to make sure that there's a decent spread there before I start going heavy, and not just buying 2% or 5% below my current average, especially if I know these types of events are happening and circling around the market, so that I don't get in a position where I'm sitting in deep into the red and I miss out on greater spreads. So keep those catalysts in mind. Of course, I'll be doing TA and giving some spreads as far as for numbers and indicators going forward. So just keep these catalysts in mind so that you can have the macro at the top of the mind awareness for your overall portfolio. You guys know the deal. Like the video if you found value. Subscribe to the channel if you want to hear more from me. Share the video with a friend so that they can keep track of the macros of the market as well. And don't forget about BlockFi. Or if you open an account with them, I have a link in the description. You will receive up to $250 in some of your favorite crypto, including Bitcoin and Ethereum. I appreciate all of you. Thank you. Until next time.